All right, good afternoon, everybody. It's Mark Cobby, and welcome to our third quarter 2020 earnings call. We're pleased to report our results. Joining me on our call today, Mikkel, Svane, founder, CEO, and chair of the board, as well as Elena Gomez, our chief financial officer. During the course of today's call, we may make forward-looking statements, such as statements regarding our future financial performance, product development, growth prospects, ability to attract and retain customers, and our ability to compete effectively. The assumptions, risks, and factors that could affect our actual results are contained in our earnings press release and in the risk factors section of our prior and subsequent filings with the Securities and Exchange Commission, including our annual report on Form 10-K for the year ended December 31, 2019, and our upcoming quarterly report on Form 10-Q for the quarter ended September 30, 2020. We undertake no obligation to update these statements after today's presentation or to conform these statements to actual results or to changes in our expectations, except as required by law. Please refer to today's earnings release for more information regarding forward-looking statements. During this call, we will present both GAAP and non-GAAP financial measures. The non-GAAP financial measures should be considered in addition to, not as a substitute, or used in isolation from our GAAP financial information. You can find additional disclosures regarding these non-GAAP financial measures, including reconciliation with the comparable GAAP financial measures, in today's earnings press release and shareholder letter, and for certain non-GAAP financial measures for prior periods in the earnings press releases for such prior periods, all of which are on our website, investor website. With that introduction, I would like to turn the call over to Mikkel.
Thank you for this thrilling introduction. Thank you so much, Mark. And thanks everybody for joining us here today. I know it's a super busy earnings day, so we all appreciate you spending your precious time with us here in our living rooms. So we entered our last quarter of the year with momentum on our side. In the third quarter, we turned the corner on the biggest impacts to our business from COVID-19. Our new business growth continued as churn returned to pre-pandemic levels. Our expansion business too returned to strong growth as our contraction trended closer to pre-pandemic levels too. All of these trends set us up well for the rest of the year. I'm particularly happy that we crossed the $1 billion annual revenue run rate during this third quarter, and also that we are guiding to exceed our $1 billion revenue target for the full year. This is, of course, a journey we've been on since 2016 when we first set that aspiration. While we are very pleased with our results, we also remain cautious. Our customers in challenged industries are still recovering, and we know that a resurgence in cases and the return of restrictions can very well make the situation worse for many of them. Through all of the challenges this year, though, it has been very gratifying to see how our products, how our solutions are helping customers, helping businesses adapt and react so quickly to the very quickly changing conditions. We see so many examples of companies quickly adopting and working through this crisis using our tools with grit and perseverance. So a big thank you to all our customers for trusting us as their partners through this. We will continue to do everything that we can to keep you fast, keep you agile, and keep you smart in your customer engagement. And before I turn over to Elena with all the numbers, I'm going to say a big thank you to all our employees, 4,000 of them sitting at home. I know many of you are listening to this call, so I just want to use this opportunity to say thank you for your sacrifice and for everything you do and your grit in this pandemic, and as we're working our way through this. So thanks everyone, and with that, over to you, Elena.
Thanks, Mikkel. Thank you everyone for spending time with us. I'm coming to you from my basement. Best internet reception. In this dynamic pandemic environment, the momentum and resilience of our business is showing. We're on track to exceed our objective to be $1 billion company and provide full year guidance that reflects 25% year-over-year growth at the midpoint, which demonstrates the strength of our business model. Now more than ever, we are seeing companies want solutions with quick time to value, which we are well positioned to deliver. Third quarter revenue increased 24% year over year and exceeded our expectations. Revenue outperformance was driven by strong demand for our solutions and improved churn and contraction rate during the quarter. We see signs that the initial shock of the pandemic is behind us, although we continue to proceed with caution given the continued uncertainty around the pandemic and economic climate. Customer churn rate returned to normal levels in the third quarter. Contraction rate significantly improved, but remains elevated compared to historical trends. We're encouraged that some of the customers that contracted with us in the second quarter expanded in the third quarter. Our net expansion rate improved to 112% in Q3, up from 111% in Q2, and continued to be in the healthy range of 110 to 120. ARR from 100 plus agent seats remained flat at 43% in Q3 compared to prior quarter, given the very strong performance of our SMB business. Total RPO increased 43% year over year. Short-term RPO increased 39% and long-term RPO increased 56% year over year. The increase in RPO demonstrates our customers' commitment to partner with us for the long term. We saw an elevated number of multi-year contracts this quarter compared to earlier this year. Now turning to gross margin. GAAP gross margin for the third quarter was 76%, up 4.1 percentage points year over year. Non-GAAP gross margin was 78.7%, up 2.8 points year over year. Gross margin improvement was driven largely by revenue scale and increased optimization of our personnel costs in our product support organization and efficiency from our hosting infrastructure. GAAP operating margin expanded by 6 percentage points and non-GAAP operating margin expanded by 4.5 percentage points. Margin improvement was driven largely by revenue outperformance, gross margin expansion, and prudent expense management. Margin also benefited from lower travel and event costs due to the pandemic. Free cash flow was $25 million in the third quarter. Now let's move on to guidance for Q4. We expect revenues between $274 and $279 million, representing 20% year-over-year growth at the midpoint. We expect non-GAAP operating income between $16 million and $20 million. For the full year, we expect revenue between $1.02 billion and $1.025 billion. We expect non-GAAP operating income between $69 and $73 million. We expect free cash flow for the full year 2020 to be approximately $15 million or higher. Free cash flow could be impacted by real estate changes we plan to make to no longer occupy 2 of our leased office buildings in San Francisco. We have remaining contractual rent payments of approximately $12 million and additional operating costs related to these buildings, which we may accelerate before March 31st, 2021. The impact from these changes has not been included in this guidance since the timing and the amount are unknown. Over the last 6 months, we have spent a lot of time reimagining how we work. A big part of that conversation focuses on our physical spaces. Our employees have adapted well to remote work. And when we do return to the office, we intend for many of our employees to remain remote. We are determining how we can optimize our real estate globally. Finally, as Mikkel said, I'll close with saying that our outperformance during this quarter could not be possible with the great teams across the organization. Our focus remains on strategically managing the company for the long term, with decisions optimized for delivering greater customer value and long-term financial growth and profitability. With a strong balance sheet and a competitive position, we are well positioned to invest for the long-term growth of this company. Mark, back to you.
Thanks, Elena. And we're going to turn it over to Q&A now. As we did last quarter, we put all of our analyst names into a randomizer, and we'll be using that randomly selected order for today's calls. And our first analyst up today is Jen Lowe from UBS. If you can mute yourselves, and if you'd like to turn on your video, we're happy to see you as well. Thank you, Jen.
Great, and thanks to the randomizer for putting me in first. Maybe just to start on that last point, Elena, you mentioned rethinking, exiting the 2 leases in San Francisco, rethinking the footprint globally. I'm sure you're not the only ones at this point in time. As you think about what that might look like in terms of margins going forward, I know it's early, but is the aspiration being that you would be a bit more cost efficient as well around your headcount with that new real estate footprint, or would that be reinvested? How should we think about what that ultimately means for the business?
Yeah, no, I think it's a fair question. We're going to continue to balance our investments focused on growth. And so to the extent that we have, savings, if you will, I think that's the question from real estate. Will we be investing that in the business? We will if it makes sense, and will continue to position us for growth. But at the same time, we're constantly looking at ways to scale. So there'll definitely be some benefits in our operating income as a result.
And maybe just one for Mikkel. Obviously the environment is incredibly dynamic. It seems like the trend was improving over the course of the third quarter, but now we're hearing, unfortunately, cases are starting to surge again. There's been rumblings of shutdowns in Europe, or actually starting to see shutdowns in Europe. Do you find that customers are a little bit more prepared for that now, given that we've been through it before and maybe not freezing up the same way we saw earlier? Or is there any change in the tone of business or how they're responding to what might be another wave of shutdowns?
That's of course the $1 million question, Jen. We definitely see more preparedness in the market now. We all know what we're in, the same way that we know what we're in. Everybody's prepared, and we see more preparedness in the market for what can come. But many uncertain factors. How hard it's going to be. It can be a rough winter in Europe, I can imagine. But definitely more preparedness in the market. I think a lot of businesses have been very prudent in how they have prepared their operations for this, and we don't see anybody overly optimistic in the market, which is probably a good thing.
Thank you.
Thanks, Jen. Next up is Brad Sills from Bank of America. If you want to unmute and use your video, you're welcome to.
Oh, I tried to start the video, but unable to, it looks like. Anyway, thanks, guys, for taking my question. I wanted to ask about the comments you made earlier on the expansion in some of the industries where you've seen contraction. I know in the past you've talked about how there's a decent amount of goodwill that's been building there, where you've been providing those concessions. Customers, will remember this and come back. Is there any color you can provide as to how that's gone within some of those hard-hit industries? Kind of where are we with some of that, business kind of coming back and even thinking about expansion?
Yeah, I'll start, and Mark or Mikkel, feel free to chime in. But we're definitely not back to pre-COVID levels in these hard-hit industries. But we are seeing some of that expansion come back. But I would definitely say we are not close to pre-COVID levels. But overall, the good news is our business is pretty broad and diverse, and so there isn't any one particular industry or segment that is really drowning out the overall financial picture for us.
I would just add that if you look at car share, airlines, and just travel-related industries, those are probably the hardest hit of our customers. But if you look outside of those impacted industries, there was definitely a return to more normal patterns, not completely normal, but a return to much more normal patterns in Q3 over Q2.
Got it. Great. Thank you. And then any color you guys can provide on kind of progress with some of these bigger expansion deals in larger organizations. Great result this quarter on the billings and backlog. So any kind of color on kind of the bigger expansion deals, and maybe even Sunshine, are you seeing some of these larger firms committing more to the platform and going wider with Zendesk support?
Reflected in our RPO, Brad, you saw, and I mentioned it on the script, you saw an elevated set of customers in terms of committing longer to us. So we're really encouraged by that. I wouldn't call out any single product, if you will, but just commitment to the Zendesk family of products. Mikkel, I'll let you chime in there too.
No, I think in general, you can look at, like, as we also put in the shareholder letter, and as we repeated here, like our expansion business is returning to strong growth that we're very optimistic about.
Great. Thanks, guys.
Thanks, Brad. So next up, we have Drew Foster from Citi.
Hey,
Drew, can you hear us?
can you guys hear me?
Yep.
Yes, go ahead, Drew.
Okay, great. Thanks a lot. Elena, I just wanted to double click on some of the latter comments that you made there around RPO. So, both current and total RPO growth in the quarter was really strong. Looks to have sort of reaccelerated from Q2. And I know that you just mentioned there you had some multi-year deals in the quarter, but are there any other benefits that metric saw in the quarter in terms of maybe some of your larger deals landing and whether there were any big renewals in the quarter as well?
We don't comment on specific customers, Drew, but I can tell you in looking back at our RPO and the contract terms over the last few quarters within this year, we definitely saw really good momentum in Q3, and it's broad-based. I can't point to any one segment, but it's broad-based. So there's nothing more to say other than, more commitment from these customers and actually encouraging to see this level of commitment in the backdrop that we're in.
Drew, I'd just like to add there, we do thousands of transactions per quarter because, we have 170,000 customers. So,
Sure.
We're not dependent on any one customer to swing that result in any direction.
Understood. Helpful. Thanks a lot. And then just another follow-up, Elena, and the Q4 guide sort of implies a little bit lower of a growth rate than we're seeing here in Q3. So just wondering if there's any areas of the business where you're sort of taking an outsized level of conservatism there, maybe a Q4 where there's more large deals than normal.
That's a fair question. We approach guidance with generally the same approach, but we are in we're in a totally different environment. So I think for me, it was really prudent to just put out a guidance when, we've got an election year, we've got a pandemic. I just felt like it was prudent to be measured about that guidance. And we're not out of the woods as we just talked about in Europe, et cetera. So that's what that guidance reflects.
Okay, thanks so much.
Thanks, Drew. Next up, let me make sure I get it right. Tom Roderick is on.
Yeah, I'm on, Mark. Can you? I think the video is going to start now. Here we go. We'll try it. Okay, excellent. Thanks for taking my question. So, Mikkel, you've always been, your business was very strong and relevant in Europe and international early on, probably, earlier than most companies for your size as you're growing up. So you've always had a great view with what's going on internationally. I think you called out European weakness, last year ahead of when a lot of companies saw it. So you got a pretty good feel for that. Would love to, hear what you're seeing in real time. In particular, it sounds like you offered a little bit of, caution relative to cases are on the rise. Europe is starting to see perhaps a little bit of a tick down. But anything beyond those sort of broader cautionary comments with what you're seeing internationally or hearing from customers? I'd love to hear what the actual, customer feedback is right now.
I'm not sure I can provide so much insight that doesn't exist already. That it's definitely gone just over the last month, things have been accelerating quickly in Europe. And that's definitely affecting the mood there. On the other hand, there is as the other question before, there is a kind of a readiness for it. We know what we're going into. We've kind of dealt with it. We all know there's light at the end of the tunnel. We just have to get through these next very important months. So I don't have any other insights about. We see great strengths around the world, even in places where we shouldn't see great strength. So I think that talks a little bit more to the fact that everybody is a little bit more prepared for what we're going through than they were 6 months ago.
And Tom, I'll just remind you for your Europe.
Maybe that.
Last year, we did reorganize how we approach the SMB category of our business. And that has had some payoff where we've enabled our self-service capabilities and improved on our customers being able to join us in a self-service environment. I think that's been very helpful for us through this period.
Yeah, that's a good reminder. Thanks for that. Quick follow-up, just more on the product side. Anything you can offer relative to the trend line of suite sales over the last 90 days, 180 days? What's happening with the demand for the suite, and what's happening with deal sizes as a function of that?
I'll take that. So we've been seeing some really good demand for our support suite. Within that support suite, there is a conversational messaging capability that's being built in as we bring more messaging channels natively. And so we feel that our bundled offers that around the support suite especially have been showing some really good demand, and actually outperforming our standalone kind of demand for support-only products.
Outstanding. Thank you. I'll jump back in. Appreciate it.
Thank you, Tom. Next up is Alex Zukin from RBC.
Hey, Mark. I think you've disabled my video.
I did not, but I'm going to try to turn it back on for you. There you go. There you go.
Thank you guys for taking the question. I guess maybe the first one for whoever wants to take it. If you think about the business from an enterprise perspective versus, velocity, talk about, where you saw most of the outperformance. Was it in, deals that were kind of held up last quarter that got done? And then also maybe just talk about the pipeline for both businesses and where you're kind of building confidence and strength.
Yeah, I can start and you guys can chime in. So, Alex, the business, if I look at the strong performance at Q3, it's really across all of our segments. So then I just shared that with the board a couple of days ago that one of the things we really were encouraged by is that we did see a broad-based return, if you will, of the business. Now we don't want to make one quarter a trend. And so we're cautiously optimistic, but yeah, I do think there were certain deals that in Q2 were, maybe put on pause, if you will, that came back. But I don't want to point to any one deal. I think the performance you saw in Q3 was really broad-based. In terms of pipeline, we're encouraged with what we saw in Q3. But again, one quarter is not a trend, so we don't like to talk about pipeline specifically anyway, but I'll let Mikkel and Mark add more color if they want.
I don't have anything else to add to that one.
Maybe just then to follow up, given this was a, kind of a unique quarter, given the puts and takes from last quarter to this quarter, and the unique year ago compare, I know you don't guide to it, but, there's quite a dispersion between, what your billings growth is, what your current RPO growth is, what your current RPO billings growth is. And so as we think about Q4, as we think about growth going forward, I know you guys don't want to make a trend out of a quarter, but that's what we do. And so what would you point us to on some of those forward looking, what would you caution us, remind us in terms of seasonality, and then also what's the right way to think about, your kind of growth outlook? Are you a second order beneficiary, from a pandemic of the demand environment? You've figured out how to sell, what to expect, et cetera, or, what's the right way to kind of put it into perspective?
So I think you got like 5 questions in one, but well played. So I think the first thing is this is not a normal year. So and we all know that. So while typically we talk about seasonality, I'm paying attention to that, but I'm not expecting, everything's going to be exactly the same. Now, encouraged by what we did in Q3, of course. And I'm not going to guide, obviously, to next year, but what I will tell you is the initial shock of the pandemic and COVID was in Q2. And as time goes on, that impact on our financials is less and less.
Yeah, Alex, I think it's really important to remember that some of that contraction we took on in Q2 from the travel, those categories, we continue to carry that until those companies bring back their employees and bring back their agents. And so that has an impact here near term. And as we kind of see a recovery in those categories, that will help us.
Understood. Thank you, guys.
Thanks, Alex. Next up is Chris Merwin from Goldman. Chris, are you on?
Hey, sorry about that. Can you guys hear me okay?
Yep, we can hear you. Yep.
Okay, perfect. I wanted to ask, sorry, I think I'm having a little trouble with my video, but as long as you can hear me, I'll go ahead and ask. I think last quarter you talked about the customer segments a bit, and it sounded like there was some relative strength in SMB and in the enterprise segment, a little less than mid-market. Curious, this quarter, given the broad-based recovery we saw in pretty much all your metrics, in particular RPO, can you talk a bit about what you saw by customer segment? Did you see some stronger mid-market performance, particularly with larger and longer duration deals? Just curious, anything you'd call out there. Thanks.
Yeah, Chris, I would just repeat what I said earlier, which is we really did see the performance in all of our segments this quarter, which we're encouraged by. It's obviously not a trend in the backdrop that we have in the macro environment, but definitely the mid-market and all of our segments had strength in Q3.
Great. And then maybe just one follow-up. In the shareholder letter, there was a number of mentions of Sunshine conversations that seemingly as part of some of the deals that you called out. I guess when we think about Sunshine, being utilized more as a core CRM platform for your customers, anything else you can share there? And is the expectation still for that to become a more material contributor next year? Thanks.
Yeah, so I can just note out that messaging and the capabilities we both offer and use through the Sunshine conversation platform is a big part of our future. We're going to talk a lot more about that in the coming months and next year, and that's something we're very excited about. It is where the trends are going.
Okay, thank you.
Thanks, Chris. Up next is Stan Zlotsky from Morgan Stanley.
All right. Hey, guys. Thank you so much for taking my question. So a couple that I wanted to double click into. First one on current RPO specifically, right? I think Alex started to allude to it, but was there any meaningful shift in customers going from monthly to annual contracting that benefited that, or was it just pure more bookings?
Yeah, I don't think that I observed a very big shift in our shorter than 12-month business mix. So I think that was just more of an indicator of the strength of our, kind of our momentum of the business in the quarter.
Got it. Okay, that's great. And then just also double clicking on some of the questions that were asked specifically into Q4, right? It's a big enterprise selling cycle. How are you thinking about that part of the business, which is usually really strong in the quarter?
Yeah, I mean, I think our guidance definitely was done with the backdrop in mind, Stan, and so we've just got to kind of see this through. I'm super encouraged and proud of the team for what happened in Q3 across all segments, as we said. And Q4 typically is our big enterprise quarter, as you note, but this is a different year. So we're just trying to be cautiously optimistic about that and not get ahead of our skis.
Got it. And so for that particular segment, is it fair to say that you applied like an extra layer of conservatism for that segment versus what you may have done in prior years?
I wouldn't say that. I think we'd be falsely precise, to be honest. So I wouldn't go there. I would just say our guidance reflects, a prudent view of the business right now.
Got it. Okay. All right. Thank you, guys.
Thanks, Dan. I don't see Shebley on the call, so we're going to move to Samad from Jefferies. Let me unmute you. Whoa. Did Samad just drop? It looks like it.
Now get there. Unmute him, Mark.
I don't see him.
Oh, there we go. Hey, can you guys hear me now?
Yep.
Yep, there you are.
Sorry, 2020. Everything starts with "Can you hear me now?" Thank you for taking the question. It's good to see you all, and I hope you're all doing well. So, I wanted to ask maybe more of a high-level question. As we think about some of that strength in new bookings, and as we think about kind of the source of new customer ads, how should we think about that in relation to, we're hearing from companies, whether it's Shopify or BigCommerce, as they're adding more new merchants. We've seen record new business formation actually in the U.S. during the third quarter. Can you maybe help us think about the mix of your new customers added in 3Q in relation to maybe the sources some of these other companies that would be adjacent to Zendesk are adding, and just how was that for the third quarter?
I'll start this. So I think that, we saw a lot of good demand from new customers, and a lot of it has to do with working with customers differently. The end customer interactions are evolving, whether it's messaging channels, whether it's curb pickup and the other kind of tools that companies need to employ. And I think we're an important, provider for that ecosystem. So I do think we benefit from that. I'm not going to say that that's like the only thing that we benefited from. The overall health of the business was much better in Q3 than in Q1 and Q2 of this year. So I think we saw a nice general recovery. So I don't want to attribute all of our upside to that.
And I guess maybe just as a follow-up to that, as you think about your customer base, when you think about where they are in terms of different pieces of technology, how long after somebody maybe either whether it's starting an online store or if they're moving to buy online pickup or curbside pickup, I guess how quickly can they set up something like Zendesk to support that? I guess we're just trying to triangulate on whether some of the success with some of these other companies is a leading indicator or a lagging indicator for future customer growth.
And this is really speculation, and I wouldn't make any correlations between these businesses. We do believe that we are in a time right now where, and we see that reflected in our own business too, with short cycles, quick iterations, very quick deployments, lot of activities, lot of traffic on the platform, that people need speed, agility, and smartness. They don't want to spend years and years on big, massive projects. They want to move fast, especially in our category when it's about engaging with customers. And that's a trend we're seeing right now. It has implications to our business, and we believe it has long-term implications to how we think about IT and IT spending the next many, many years.
Great. I'll turn it over to the next analyst. Thanks again, and good to see y'all.
All right, thanks, Samad. Good to see you. Next up is Phil Winslow.
All right, hey team. Thanks for taking my question. There we go. There's the video. A question for you, Mikkel, and then as a follow-up to Elena. Mikkel, some of your research in the benchmark data shows that ticket volumes are up significantly year over year. I think in the high teens, 16, 17%. It hasn't really been going down. The question for you is, what are your customers doing to deal with that so that mean time to resolution doesn't go up? Is that what's driving the interest in things like Sunshine Conversations, chat, just different types of channels that are maybe asynchronous versus synchronous? And then, Elena, if that is maybe what's driving some of the interest in those, how do you think about penetration of those add-ons into the customer base, and how do you expect that to evolve? Thanks.
Elena, maybe I can start here, but no doubt, Phil, that we are seeing a flurry of activity and a lot of traffic on our platform. And a lot of that is because it's moving from other channels where you don't have the option today, moving a lot from offline to online. And it becomes natural, simple, this is where you engage with your customers. Your customer engagement is now online primarily. There's no doubt that as businesses think about how can we provide a fantastic customer experience this way, and especially for a lot of the new ones that are seeing a ton of new volume there, they're thinking about how can we increasingly automate this, give our customers much more self-service. And that's, of course, also where we help them with all these tools for providing a great self-service experience. But that's also traffic on our platform. So we're going to continue to see a ton of traffic, ton of products to sell to our customers. Very excited.
Yeah, Phil, I'm just going to add from penetration point of view from our customers, messaging channels are all fairly new. So we're in the first couple innings of this, but definitely consumer demand to message with companies rather than wait on hold for. Yesterday I called Delta Airlines 58 minutes. That's, not acceptable this day and age. I also, though, think customers are also looking at using our Explore products so they understand more of the data behind those customer conversations. And like Mikkel said, the help center, the ability to self-serve is very critical in this world. So I think, we're seeing a lot of that demand out there, and we have a nice portfolio of products to serve that. So we're pretty excited.
Yeah, so Elena, I'll add in a ton of add-on to the model next year, right?
Be careful Be careful.
Remember, though, we also offer a lot of bundled support, suite offerings that raise the average selling price on its own. So as you think about building your models, a lot of our customers are coming to us with a more bundled mentality around the support suite, for example, and other products, other bundles that we might create in the future.
Great. Thanks a lot.
All right. Up next is Koji from Oppenheimer. Let me find you on my screen here.
Hey, Mark. Dodger hat.
There you are.
Gotta give the go Dodgers. Hey, just real quick, one question from me on the dollar-based net expansion rate expanding by a point to 112%. That's really fantastic, and I think that should mean that the trough number of the last quarter is hopefully behind the business. So I guess, can you walk us through the mechanics of the expansion? Was it seat expansion, more products, maybe a combination of both of that? And really thinking about the downside too. I mean, what would it really take from here for that metric to dip back to the 111% we saw last quarter? Thank you.
Yeah. So, Koji, you're right. I mean, I think that that number is obvious. First of all, it's in a healthy range for us. We don't like to take any one quarter and say this is a trend. But that said, I think it was impacted by the contraction we saw early in the year and continue to have a little bit of a lag on that. Just remember that that's an annual metric, right? We look back a year. So that dynamic, as Mark said earlier, is going to continue with us for a little bit, but we're encouraged by the expansion we saw with some of those customers that contracted in Q2. At least a quarter of them are back. Now, they're not back to pre-COVID levels in terms of expansion, but we'll keep an eye on that. But for that to get, to continue to decrease would mean another elevated level of churn and contraction. And we don't know that, right? With this environment, we just don't know. It's hard to predict.
Yep. Great. Thank you for taking my question. Appreciate it.
Thanks, Koji. Next up is Derek Wood from Cowen.
Great. Congrats. Good to see everyone. Wanted to ask my first question on pricing. And I know, just kind of curious how you've dealt with that throughout the pandemic. I think you kind of had been more forgiving and given concessions and working to preserve TCV was some of the things you talked about early on. How has that evolved to where we are today? And are you enforcing more pricing? Are you less focused on these TCV flexibility contracts? How should we think about how that's evolved?
Yeah, so you're right. In Q2, we had to do a lot more of that, especially early on when COVID hit and there was a lot of uncertainty. It's not to say that won't happen to the extent we have customers, but it's gone down significantly from the Q2 levels. And to the extent we could, our approach was to preserve the total TCV for those customers and do the right thing. And we do believe that will pay off over time.
Great. And maybe I just to kind of hit on geo performance. I know you talked about pretty broad base from a customer segment standpoint and a go-to-market sales motion standpoint. But how about geo? I look at kind of calculated growth across. Looks like EMEA and APAC accelerated a little bit. US decelerated, but those can be backward-looking numbers. And so just curious from a booking standpoint, how you characterize geo performance in Q3.
Yeah, no, I think we had good performance generally around the globe. I would say EMEA definitely had a strong, we had unevenness, I think it was last year, and we brought in some leaders there, and we saw pretty strong performance in Q3, and LATAM too. But I wouldn't say, any outliers, if you will. I think all around we had, globally strong performance from our regions.
Great, thanks.
Thanks, Derek. Next up, let me see, is DJ Hines. Let me find you on my page here.
Hey guys, you got me?
Yep, there you are.
Awesome. Hey, so Elena, you talked about customers making longer term commitments, and I guess I'm curious what the trade-off is there. Are you having to bundle more product? Are those relationships more back-end loaded? Is it favorable pricing? Just like any broad color on how those contracts are structured to get longer term deals done in this environment?
They're all a little bit different. I don't know that if there's one thing to point to. I think it's really the focus on improving the customer experience and moving quickly, as opposed to the way we're setting up the contract terms. These are companies who are realizing the urgency of sort of the meeting their customers with digital channels and things like that. So there isn't any one trend, and they're all a little different, as you know, when you get to larger customers. So there's nothing I would point out here that's unique.
Yeah. Okay. And then Mikkel, maybe one for you. Curious what you're seeing on AnswerBot. We had Five9 tonight as well, and they talked about interest in virtual agents. They made an acquisition in the space. Customers trying to do more with less. Are you seeing the same kind of interest there? And what's adoption with AnswerBot look like?
Yeah, we're very happy about AnswerBot adoption. We have a lot more coming up to improve in that field, a lot more that can help with automation and kind of improving for optimizing for the customer experience. Not all automation gives a better customer experience, and we're very focused on providing that better customer experience by simply making it a lot easier, snappier for customers to help themselves. So very happy about it. It's been for a lot of our customers, when they've seen this massive spike in traffic that they've seen, it's been a lifeline for a lot of them, that they have this extra level of help that gives the customer some kind of confidence that they're not just waiting, but like they have an opportunity to help themselves too. So very happy about it.
Awesome. All right, guys. Thanks very much.
Thanks, DJ. Next up is Ken Wong from Guggenheim.
Hey, great. So it was pretty clear that 3Q is in a better place than 2Q. Would love to get a sense of what the shape of the improvement looked like through the quarter, maybe even to the extent you can comment on October. Any sense of what that in terms of the improvement looked like?
So I'm definitely not going to comment on October, but in Q3, but that was a nice try. In Q3, we had a great quarter out of the gate, and obviously pacing always is an important factor for us. But that was encouraging. I think there was, it's almost like our customers kind of got back to normal. Things settled in. People got kind of used to working from home from their living room. So there was a little bit of, we're not back to normal, so I don't want to signal that, but definitely more adjustment to the environment we're in. People got more comfortable making decisions, et cetera. And we saw that pretty much out of the gate.
Got it. And then maybe just circling back on the new paid customer dynamic, I guess on that metric, how close are we to normal? And any sense of kind of when we might get there?
Well, I think it's always difficult to predict normal set of new customers we bring in over time, especially since we're starting to sell more of the suite where we have multiple products being sold. But we were very happy with new customer activity in this quarter. I think that we have an opportunity and a compelling story as customer service becomes a much more integral part of the demand environment. So I think we're well positioned. This quarter, new business was definitely a key contributor to our growth rate.
Great. Thanks a lot, guys.
Thank you, Ken. Next up is Brent from Piper. Hey, Brent.
Hey, how are you?
Good.
So yeah, listen, I appreciate the randomizers, but with given back of the list here, next quarter maybe we should go alphabetical.
Nice.
That might not be fair to Zukin. So, but all good. Two questions, if I could. I guess first, Mikkel, I'd love to get your view around larger brands. We're seeing larger brands embrace this whole direct-to-consumer wave here for the last 6 months. Zendesk is the gold standard for direct-to-consumer support for the digital natives. My question is, are you seeing a change with some of these larger brands that are struggling, that have maybe a greater need or want to modernize their support apps as they try to engage consumers with these new digital channels?
Well, I think that we all see that. I apologize for the noise here. There's a UPS truck outside my window.
I'm sure
I think we all see that in the market, like across the spectrum here. Like we all read stories about Disney and Home Depot, et cetera, and they're definitely accelerating kind of their D2C, their direct to consumer, or their direct to consumer model. We're seeing that across the board.
Fair enough. We'll dive into that maybe offline more. It feels like it's a bigger opportunity here. I'd love to explore. And then I guess, Elena, as we just think about maybe the broader support business, 2,600 net adds here on the support side, that's actually higher than we've seen in each of the last 3 quarters. So as you think about the acceleration and just net support adds, what drove that in Q3? It seems a little unusually strong here, and love to get any color on what drove that acceleration just across the support business.
Yeah, I don't know if I have any more color for you, Brent, other than we had, momentum in our business for the quarter across all of our segments, and we're really pleased by a lot of the self-service and investments we're making to make our, web try and buy motion very friction-free, et cetera, and that continues to be a really important part of our journey here. So other than that, I don't know if there's anything I'd point out different, other than we saw really strength across all of our segments in the quarter.
Okay, great. That's all I had. Thank you so much.
Yep.
Thanks, Brett. And next up is Arjun from William Blair.
Hey, guys. Can you hear me?
Yep. And if you'd like to start your video.
Oh, there we go. Okay. Hey, thanks for taking my question. Quick one, maybe for Mikkel. It seems like the new customer activity has picked up. Just when you're looking at across these new customer ads, can you get a sense for how much these customers are making a new platform decision where they're saying, Zendesk is my customer service platform of choice versus maybe trying to solve somewhat of a more immediate and urgent, digital problem that has just arisen because of the pandemic? Are you able to decipher that at all?
Yeah, Arjun, I'm not going to sit here and 10,000 businesses decided we would be that platform of choice for the future. That's not the climate we live in today. I think that customers come to us because they trust us to be somebody who can give them and help them with quick results and really, get up and running quickly and harvest the results. And they believe in our agility and our flexibility to continue to scale with them. And that's been our premise since we started this business, to kind of be a very agile tool for our customers. And that's what we're focusing on. And the climate we're seeing today is a lot of activity. And that goes all the way from small business to the large enterprises. And, we are a good partner for our customers on that path. But again, as I said before, I believe this is not just a moment in time picture. I think this is a trend for the future, and that's how we're going to think about our IT investments going forward. Nobody wants to do these 3-year projects anymore.
That's fair. And maybe on that last point between SMB, mid-market, enterprise, I know we had talked about in the past about accelerating kind of the enterprise motion with your with your sales team and account-based marketing, things like that. When when you're looking at the current environment, have those resources shifted at all? Are you focusing more on small businesses, mid-market, or is it still, let's push into larger companies and the enterprise?
Well, I think we are investing across the board here, also because we see a lot of activity in the enterprise that isn't like what we would characterize as traditional enterprise activity. There's a lot of movement, there's a lot of activity like that. So we are continuing to invest across the board. I think where there's definitely or where we're definitely kind of native for the small and the mid-sized businesses, there will always be things we believe we can do better for the large enterprises, and we will of course continue to invest in that.
Perfect. Thanks for taking my questions, and congrats on the quarter.
Thanks, Arjun. I think I didn't see anybody join that was on my list that we missed. So at this point, we're going to close this call. Just a reminder, a replay of this call will be available on our investor website shortly after this call. And if you have any follow-up questions, you can email ir@zendesk.com, and Allison on our team will make sure that we get you on our calendar for a callback. And thanks again, and we'll see you next quarter.